good. It would be good if we, could see some pictures of people, at least. So when I'm talking, I'm not just talking to names, but I'm actually talking at least to photos, even if you can't put your video on. So like Eva has said, today we'll be handling the role of, give me a minute, we'll be handling the role of insurance in financial planning. And I'm really happy to be speaking to, people who've already taken a step in terms of, trying to get financially literate. Laud you for that. So I want us to get right into it. And a minute. Sorry. All right, so in terms of what we'll be covering today, we're looking at personal financial planning and a bit on pillars of wealth management and how that dovetails with insurance. Then we'll be looking specifically at how insurance contributes or participates in your financial plan. Then because today, last time we talked about education planning, today we are being very specific. We are looking more at life insurance and a bit of retirement planning, and we'll be looking at what are the key elements, the benefits, the type of life insurance covers, how much do you purchase, how do you know even what you are to purchase, and then we'll be looking at one or two case studies. So like I said, today I want us to be a bit interactive, so just allow me to drop a question in the chat, which I'd like us to respond to, even as we continue with the presentation. So please feel free to respond to that as we go on. So we'll be looking at a number of scenarios. Like I said, is my screen moving?
You're still on the training outline.
Oh, I'm still on the training outline. Give me 1 minute as I try and sort out what the issue may be. Okay, my apologies for that. All right, so like I said, we'll be looking at different scenarios. So I will pose a scenario and then I want to hear, or at least in the chat, what your reactions are to this, and then we'll be reviewing them as we go along. So, and as we think about them, think about cases maybe that you may have come across, because these scenarios are to help us appreciate, how insurance contributes to financial planning. So the first scenario is a breadwinner who is critical illness. And here I've given an example of cancer. And as a result of this critical illness, they become incapacitated. I mean, in your own analysis, what is a possible, what would happen to them, to their family, financially, socially, and especially in terms of negative impact. And I think even as we think about this, I think we're seeing cases even in, in the public and in media. I think we had the case of Catherine Kasabuli, one of the recent ones, diagnosed with cancer. And we saw how that unfolded. And you see, we could look at her and think this is a person who was well planned. Perhaps they had a medical cover. They should have had other assets that may have contributed to that. But yet we find at the end of the day, what happened, and it became something that now was in the public, in the public eye. So that is scenario number one. Now, scenario number two is again a breadwinner. And here, when I'm talking about breadwinner, I'm also cognizant that for the middle class, most of us are two-income families. So you have the man and you also have the wife also all working together and contributing, hopefully, to the family budget, depending on your family dynamics. But that is a most common scenario. Or you could find one is in employment, while the other one is, say, in business or something. So here, breadwinner means both, either one, but especially the one, because you always find you don't contribute at the same level. So if especially the primary breadwinner is affected in any one of the following ways, what would be the impact on their family? So the third one is a breadwinner loses their job and is unable to find gainful employment, over the next 6 months, and they're still servicing a personal loan, a mortgage by the time they left employment. What happens? So the next scenario is a breadwinner who retires at age 60, but unfortunately has no pension or any other income in retirement. And because I came across very interesting global statistics, which I'll share, that are relevant to this scenario. Now, the global life expectancy globally in 1913 was 34 years. But as of 2022, that is last year, it had significantly improved to 72 years. So that is global statistics, as per the WHO and also the UN, the body responsible for population statistics. Then when we come, when you come closer home, you may be wondering, what of Kenya? So the average life expectancy for the Kenyan is currently 67.5 years. And interesting enough, it's different for men and women. So you find for Kenyan women, it is 70 years, where for our male counterparts, it is 65 years. So sijui boy child, where are the 5 years? So that is something to ponder. So, and we can see from these statistics, people would definitely live long, well beyond their what we'd call the normal retirement age, that is normally age 60. So then we have another scenario where a breadwinner dies before the age of 60, but maybe they started their family late and they leave dependent children who still need education. So what is the impact on that on their family? And because now we are the investable community, I know you've all gone through, how to get in assets, as part of your investment planning. So what happens? That you had put all your money in a residential commercial property that was your retirement plan, and this is completely razed by a fire. So these are how many? These are about 6 scenarios that I'd want us to think about and even to react to. And let me just stop sharing and get into the chat and see what answers. Like I said, I want today to be a bit more interactive than last time. So kindly, please feel free to react to any of the scenarios. I can put them up again. Sorry. So those are the scenarios in their entirety. So a breadwinner is diagnosed with a critical illness. They become incapacitated. They can no longer earn an income. What is the impact? Another breadwinner is involved in an accident. that they do not die, but maybe they get a total permanent disability, like the loss of limbs, maybe paraplegic, loss of eyesight, loss of hearing, in such a way that they're no longer able to continue with gainful employment. Then the third scenario, we've seen that where the breadwinner loses their job, and they are out for a period of more than 6 months, maybe due to economic conditions or many other things. And while they left employment, they were unfortunately in debt, and they are still required to be making their debt repayments. Then the guy who retires at 60 has no pension or other retirement income, and is looking at another 2 years, 20 years post-retirement in terms of being alive. Then the breadwinner who dies before age 60 and leaves dependent children who are still in school. And then we had the last scenario, which is property. That was your retirement plan that is completely razed in a fire. So kindly let me have your reactions to this. Okay, I can see from Limo, the family can get in debt while paying for medical bills, true. And I'm assuming that is a reaction to scenario number 1. Then from Eve, it says the family may be plunged into poverty, debt and loss of assets like their home. Very true. And I think we've all seen this happening. You are doing well while working, while, able-bodied, but something happens and now you're no longer the same income level or no income at all. And now you're forced, to move out of your plush home in Nairobi, probably sell it and, have to move up country. Then we're seeing from Priska, significant and negative changes in lifestyle of the different families, even with retirement. And yes, it's very true that the parents then end up being dependent on their children. And children of nowadays are not as good as we used to be. They don't want to be black taxed. So, they tell you as a parent, jipange, be very ready with your retirement plan. They have no intention of becoming your retirement plan. So asanteni sana for the reactions. And let me get back to the slides. So we have these scenarios. So we have these scenarios happening, and give me a minute. I don't know why my slides are not moving again, but just give me a minute to sort out that. Give me 1 minute to reopen that and reshare. Wow, and at least I can see also another reaction that, about depression. And that's a natural outcome when things are not working out. Unexpected things have happened. And now, the life that you envisaged that you'd be living is no longer the life you have. And we've seen many people plunging into this kind of scenarios. Sorry, so allow me to share once more. My apologies for that. Right, so we've already handled the different scenarios, and we've seen the reactions. So in the case of sickness, possible effects are loss of income. You have to sell your assets. You have to liquidate your investments. And of course, there's a strain on family relations when people are not doing well. And I think we saw quite a bit of this in during the COVID times. And we find there were many cases of even, domestic violence and, many family breakups. Then of course, there's the loss of income. If the risk there is the loss of income, and then we have a lifestyle disruption, we have the loss of property and assets, and even again, a depletion of investments. Then there's loss and damage to property, like say, like the residential core, commercial building we're talking about that was a retirement plan for someone, then we see loss of income from assets. We see, I think it's if we had said the loss of a home, and then again, you may be liable to third parties. So supposing there was a fire and it emanated from your building and unfortunately affects your neighbor's house, they're going to come after you, to compensate them. And woe unto you if you don't have like liability insurance to cater for those kind of eventualities. Then in the case of injury and disability, we see then loss of income because you're not able to work. Again, your lifestyle is disrupted and that of your family. And then eventually it leads to depletion of your investment. If you had savings, those are the first to go. If you had something, a money market, that would be the first thing that goes. If you had probably bonds, then, you'd be looking to sell them. If you had assets, maybe land, maybe houses, say in the case of, like a serious disease like cancer, and maybe you did not have a medical cover. And again, I think it's also something we need to know. I don't know how aware we are even around medical insurance, that when it comes to, say, critical illnesses, you could have a very big cover, say your cover is even 10 million, but you'd find from that 10 million, maybe what you have access to for cancer and that kind of thing is only $1 million maximum. And it can be anything from, 300, 500 and to $1 million. So you have a very big cover, but because of the sublimit under your medical insurance cover, then you find that you're still exposed. And I think that was the case for someone like Catherine Kasavuli. Then again, living long, like you've seen, what the global statistics for life expectancy are, living long and retiring, but without an income. Then like someone said, you become a burden to your family. Again, if you had accumulated any assets, those are the first to go. And, you'll be selling your land, you'll be selling your house. I even know of someone who then, sold everything they had and then, moved, left the family and went to live somewhere by themselves. I hope we are following. Then again, death before retirement. We all assume that we all get to live to, age 60 and beyond. And no one really anticipates that, your life will be cut short before maybe, you could be building your investment portfolio, but then you don't get, to complete that before, before you pass on. And I think last time we're talking about education planning, and we were seeing some of the different ways, apart from insurance, that, you can use to cater for your children's education in future. But unfortunately, accumulation, as will be seen as we look at the pillars of wealth management, accumulation of wealth takes time. Building an asset portfolio takes time. And unfortunately, as human beings, it's the one thing we never can guarantee. And just to share an incident, I had a young man who I think I started talking to, them and a colleague. He was working in an establishment that was an agrovet. And actually one of the evenings left work, had a bike, and just a few meters from where he was working, got into an accident. He was not wearing a helmet. And the guy, 26 years of age, died on the spot. He had a young wife who was not working. They really were all young. And they had a daughter who was around 3 years. And apart really just from, the whole, the grief around the whole situation, there was also now this girl, she was from up country. She really beyond, I think she hadn't even completed her Form 4. She really had not invested in any skills, and now she had a child to raise, for the rest of her life. And, the husband was gone. So sometimes, yes, we all pray for long life and we try our best to live that long life, but sometimes it is not guaranteed. And so death before retirement means then you leave your dependents exposed. So the next thing I want to ask us, and I believe many of us are parents, maybe grandparents, and there's a concept of saving where when we're trying to train our children in terms of saving, we normally give them piggy banks, and they put the money in the piggy banks and fill them up, and once that is full, then they can take the money to a bank account. But I also want to ask now as adults, for us to reflect on 3 piggy banks that we should, because we're talking about financial planning. Do you have this piggy bank? And if you do, is it adequate? So reflect on it, and probably you can put your answer in the chat as we go along. So the first piggy bank is emergency funds. And this should be 6 to 12 months worth of monthly expenses. And we saw the scenario of the person who lost their job, lost their income, and unfortunately are not able to get into gainful engagement, within a 6-month period. And sometimes you can find someone staying out of work even, 6 months, 9 months, 12 months, but even people 18 months and even more. So sometimes we, during loss of loss of a job, we may not be able to get back on our feet as quickly as possible. So the first piggy bank we need to have is at least, to be on the safe side, 6 to 12 months of your monthly expenses, not just of your income, because you see your income had many deductions, which maybe now, once you're out of employment, are not relevant. But what are your normal monthly expenses? And do you have that money aside somewhere? Maybe in a money market where you can easily access that. So that's the first piggy bank. How well funded are you in this particular piggy bank? Now, the second piggy bank is medical, your medical cover. And here we'll be looking at two scenarios. Medical cover in terms of the one that pays for, normal ailments. But there's also the medical cover that's, that is required in case of a critical illness, like the instances we're seeing, like for Catherine Kasabuli. Probably she even had a very good medical cover, but maybe the sub-limit on it was a maximum of 1 million. And right now, cancer treatment locally, and even maybe where it requires you to go abroad, is quite costly. And I think there was that other media personality, her name was Janet someone. And I think she documented her journey publicly in terms of what she was going through, how much it was costing. And you can see, the costs are really not that small. So apart from your normal medical cover, which you may enjoy if you're in employment, maybe you're enjoying it under your employer, or maybe if, say, you're in business, hopefully you do have a medical cover. But apart from that, then you will need, especially for critical illnesses, a medical cover that is at least 5 times your annual salary or annual income. Then piggy bank is for your future. And here we're talking about income protection in case you lose your income, either through disease, disablement, or even just loss of a job and you're not able to get back to work immediately. And then we're talking about education planning, and that we looked at in depth last time. And that is still, again, futuristic, because your children may be small today, but in another 10, 15 years, they'll be in a stage, say, of education where you really actually needed to have had a plan. And then we're also talking about retirement. And we've seen now, based on the global and even local statistics around life expectancy, that we get to live long. But what kind of life? What kind of life will you be experiencing, and how prepared are you for it, post-retirement? And then again, we're talking about estate planning. And this is looking at, as you get to those later stages of your life, and even beyond your life, how have you planned yourself and your family, beyond yourself? So I will stop sharing here just to try and see how well are we doing in these piggy banks. Are we, and maybe not just to really give details, say piggy bank number 1, adequate, number 2, needs work, number 3, no. I'm set. I think it would be good. Like I said, today we will interact quite a bit, so kindly bear with me. So let's see some answers. So piggy bank number 1, maybe we can first give a reaction to that. And number 2 and number 3. I'm waiting. So I'll wait until I have a reaction from someone before I continue with the slides. Hello, are we still here, Eve?
Yes, we are still very much here.
Right, not just like I'm saying, don't give details. Just say number
nizungumze.
one, I'm good. Number two,
Okay,
need
Nana,
some
tell me.
work. You know, big answers, but you know, at least
Stephen Keys anajita John 5 months anaonekana 6 months anatupenda na big.
Awesome.
all right. I think we can move on. I'll be checking on the chat just to see whether some people who was brave enough to put something. You know, you don't have to give details. You know, me, I'm only at 2 months, you know, on emergency funds, or I don't have anything. Just, you know, say need some work, work in progress. Such we also encourage one another. So moving on. Okay, thank you. I'm good in number 1 and 2. Excellent. Number 1, thank you, Priska. Work in progress. Number 2, catered for in workplace. Just a question that will be coming to later. You will not always work there. So what happens when you step out of employment? Number 3 for Terry is work in progress. I'm guessing she's good on all the others. So well done to those who are brave enough to share with us. So let me get back to the slides. So the topic today is really personal financial planning and how insurance contributes to that. And I think since you guys have all been in Investable, I'm sure you have a background around this, what it means. And, you know, you're trying to maximize the financial resources you have now, and you're trying to, you know, put this into managing your finances so as to achieve your financial goals. And some of the things that are in this are goal setting, and these are short-term, medium-term, and also long-term goals. You're looking at your net worth. These are your assets and liabilities, your cash flow and expense management. That is your budgeting. You're looking at investments and your savings management, how that is going, debt, in case you have any debt, how you managing that, especially as you approach retirement. And then again, retirement planning, how well planned are you for your retirement? Do you have enough money? Do you know how much money? Can you project how much money you require in retirement? And even if you have a pension plan with your employer, do you know how much it's going to give you by the time you're age 60 and you have to leave employment? And there's also estate planning beyond, you know, yourself and your lifetime. What are you doing and how are you planning around your dependents? Because the fact of the matter is we don't live forever. You know, at some point in time, we all exit, but you know, how well planned are we? And will we believe in, you know, issues and problems to our dependents? And we can see that there's been a lot of that in media, or will we have organized ourselves? And I'm saying here that a good financial plan is incomplete without insurance. And we'll be seeing why that is so. So like I said, we'll be looking at pillars of wealth management, and there are 3. They can also be distributed into more than 3, but here I'm using 3. So there's the accumulation or creation, and this is normally between ages. By the time maybe you join the workforce from age 20 or 21 all the way to 45 years, then you're very busy accumulating wealth. Then maybe between age 45 and 65, now you're doing what we call consolidating. What you've accumulated in terms of your assets, your savings, your portfolio, you know, your plans around retirement and all that. And then now towards beyond, after retirement, then really you're looking to deaccumulate, because one of the needs in retirement is really liquidity, and that is really key. So you're deaccumulating, and also you're thinking about how you're going to pass your wealth to the next generation. And I'm saying here, insurance is useful across all these 3 pillars of wealth management. And so in accumulation here, we're talking about how we create, accumulate, and grow wealth. And this could be from income, employment, business, royalties, those kind of things, from your savings, investments. And we did see that we can also use insurance policies as a means of saving, not as an investment, but as a means of saving. And like I said, when we are accumulating wealth, between these ages of 21 to 45, we always assume that time is on our side. But like I said, time is the one thing that we are not guaranteed. And just to give you a story, there's a class we did with Eva called Couples and Money, a faith-based a program around wealth management, handling money as couples. And one of the couples in our group, the husband was in business, the wife then was not working. But in the course of doing that course, she actually got employment. It was one of the challenges, how can you use your skills, to better your family income. So in that process, she got a job. But then in terms of, like I was saying, family dynamics, now the husband was in business and he was buying all the property. He was in business actually with his brother, his blood brother, and all the property that they had accumulated. One, the wife was not in the know. And then two, it was actually bought in the name of that company, not as an individual. And so we did the course for about 3 months. At the end of it, I think 2 months after we finished the course, just received news that he had a heart attack, now the husband, and passed on. And apart from the shock and all that, and for them it was a bit sad because they had 2 children, and one of the children was actually a special needs child. So requiring a lot of care, a lot of equipment, physiotherapy, and all that. And so here the husband is gone. He was the primary breadwinner, because unfortunately the wife had gotten a job, but it wasn't earning much. Then unfortunately for her, because all the property was actually under the company, the business, she really has no access to it. And the brother now is actually trying to, take it all. So here she is really struggling to put even food on the table with her income. And luckily, at least they had a home, so they are able, at least they're not out in the streets and all. But every time we talk to her, it's a real struggle. And this is a family that was doing well while the husband was alive, but now she's wondering, how shall she continue with the care for her daughter, and even how shall she then be able to pay? Will she be able to give them the same kind of lifestyle that they were expecting, from their fathers? And so these are real things. It was a shock to all of us. The guy was they are all in their early 40s. He was expecting to live to 80, but he's no more. And now the family is left to grapple with some of those things. So we always assume when we are accumulating wealth, when you're putting in that education plan for your child, that you'll be there to even see your child educated. And if you're lucky, that happens for us, but we also know real life stories where this is not the case. So protection, and I think we looked at this in terms of the risks that we face on a daily basis: sickness, loss of income, loss and damage to property, accidents and disability, a long life with no income. And the last of it is death, but you actually die maybe before you have put your house in order. And we're seeing any of this, and it's something at least all of us were able to appreciate, even from the scenarios we looked at, that any of the above risks can deplete everything you have created and accumulated in Pillar 1. Your entire portfolio of investment, your bonds, your money market, your crypto, if you are into that, and all those kind of things, your rental properties, even your home, all these can, be wiped away when you're faced with some of these scenarios. And then when it comes to distribution and wealth transfer, then how do you pass it on to the other generation? Because like they say, you collect it, but you can't go with it. And but some people try and go with it. Like we had a scenario. He was actually a foreigner who had then adopted a Kenyan family, raised them up, taken them to the best of schools and all that. But when he came now, he was sick. And so when near death, what he did, he actually sold everything, all his assets, transferred, went back, left the country, went abroad, put himself up in a hotel, and actually, as we say in Kenya, ate his money until he finished it and died. So, and left the family that he had adopted not doing very well. So there are people who do try and go away with it. And so when it comes to distribution and transfer, we're looking at estate planning, we're looking at your beneficiaries, your administrators, and your trustee nomination, depending on how you want to set up your estate. And this is really important. Like the case I was giving you for this gentleman, everything was under the business. And now his wife and children are really suffering, with bread and butter issues. Yet, there is so much that the father had accumulated for them, but unfortunately, it put in proper vehicles. And so as we are thinking about estate planning, let's think about how best do we leave things in order so that even if we're not there today, we're not leaving issues for our dependents. And so here life insurance also comes in, and again, insurance can be used as a tool of both distribution, and we'll be looking at this more in depth. And so, what then? I think we've seen risk and the risks that we face as individuals, even as we are trying to build our wealth and we are trying to put together our financial plans. And it is because we face risks as individuals. That is why we need insurance. And so insurance is important for risk mitigation. That is something that the risk, like say for critical illness, you can actually take something that will help you mitigate that risk. It helps with financial security, your asset and income protection, and we'll be seeing how we can do this. Then it also gives you peace of mind that, yes, I've accumulated this, but I know I also have a plan in place that should things not turn out as I expected, then I have that covered. And we're also talking about that insurance, especially when it comes to savings plan, it helps you in the development of a disciplined savings culture. And I know last time we talked about education planning, and I think the feeling is, let me put my money in money market or in bonds and use that maybe as or in hard assets like land or rentals, and use that to educate my children in future. But sometimes you could put money in money market, but then you don't have the discipline, and a small thing could come up, an emergency can happen, and then you wash away everything that you had accumulated in your money market fund. But with an insurance policy, at least it's a discipline that money will only be accessible at the point at which is needed, say for education or whatever it is you're saving for. Then again, lifestyle protection. That because you have insurance, for example, and I'll use maybe a physical asset like your home. So supposing you had your home, you've taken home insurance for it, and there's a fire. You get money from insurance that can help you reinstate your home, or it can help you even build a new home. But in the absence of that, then probably you have to leave your home, maybe liquidate another asset to be able to put back up your asset. So again, lifestyle protection. If the breadwinner is not there, lifestyle changes for your family. You can no longer afford the kind of life you are living before the risk happened. And so I say insurance buys you time, because we've seen sometimes we all hope that we'll live to age 60, we'll live to see, to complete our financial plans, but sometimes that doesn't happen. So what insurance does is that it buys you time, and we'll be seeing how that happens. So I trust we're still there, people. I trust that we're still there and following. At least it's good to get some responses. Like I said, with Zoom meetings, you may feel like you're just talking to yourself, and especially when there are not even photos to show you who the people are. So we're looking at risks, the risks that we face and how you can mitigate them using insurance. And so we've said, so we're looking at if it's sickness, then you can mitigate this using medical insurance. But like I said, medical insurance is not enough because of the sub-limits for things like critical illnesses. So you need to take then a critical illness cover that can give you, in case you're diagnosed for the first time with a critical illness, then it can give you money. And here you can choose your limits. And you'd find like maybe for a limit as, say for a limit of about 1 million, you'd be paying about 1,000 bob per month, for that. And so this is something really important because yes, medical insurance, you could have it and have it even through your employer if you're employed or even you've taken a cover on your own. But because it doesn't adequately cover you for critical illness, then it's important to have the critical illness that is a cash benefit. This is money that's actually paid to you. A medical insurance policy will not pay you cash. It will actually pay a hospital or a doctor for your treatment. Then when it comes to loss of income, what can you do about this when you're faced with such a risk? How do you mitigate? Then you can do this using an insurance retrenchment cover. And I think I did say that we have examples in the market, like the likes of there's one, a collaboration between Standard Chartered Bank and Prudential Life Insurance. So they have one, and I think for about 1,000 again, about 1,000 bob, then you're covered. You're covered in case of retrenchment. You're covered for a period of between 9 to 12 months worth of your salary, as long as your salary normally comes through that Standard account. But I see also other banks have that. I know Stanbic also have such a cover. And I think this is a really critical one, because we've seen a lot of layoffs from employment, especially during the COVID period. And it's something that is still, we are still not out of it yet in terms of the economic impact of COVID. And so, businesses are still struggling and retrenchment is a real risk. So again, loss of income, if the income is lost because of sickness, then again, the critical illness cover will come in. If you have a disability cover, and in case maybe your loss of income, you get into an accident, you're disabled, you're no longer able to work, then a disability cover at least will give you money that can enable you then, take care of your bills. Then the other thing is a third-party injury. It's also a risk that you could injure someone else. You could injure their property. And for this, then what kind of covers can you take? How does insurance come in? You can take a personal liability cover. Like I said, someone can come and be hurt in your home and they sue you. What do? Or maybe a fire started in your home and God forbid it gets to your neighbor's home. And and now maybe it raises their house to the ground, they take you to court. You're required to make good, their home. If you, of course, you don't have, when you're putting together your investments and savings, I'm sure you don't take care of, incidentals like burning your neighbors, your neighbor's house getting burned. So personal liability insurance comes really critical here. If you're a professional, maybe a doctor, an engineer, a lawyer, or even now most professions, and maybe in the course of running your profession, you injure someone, or maybe even give bad advice, or someone dies on your table, or gets an outcome that is not favorable. I've seen very many cases of especially doctors being taken to court because of things that happened with the person, and it becomes really emotive. And if you don't have a professional indemnity cover, then if you're sued, that money will come out of your pocket. And again, you either have to sell an asset or find a different way of funding this liability. And again, someone could maybe have a rental, a rental property. You don't have public liability cover. Someone in the course of, your property being cleaned, someone was visiting the building, comes and is injured, they hurt themselves and they sue you. Then, public liability insurance will come and cover that. And again, the one we really know more about is the motor third-party liability. Someone is injured either in your vehicle and they're not your family member, or you collide with another vehicle, you're to blame. Then the motor third-party liability then will handle those kind of things. Again, we've discussed loss of damage to your property and physical assets like your car, your home, either through a fire or burglary, it's burgled and your things are stolen. Then insurance can also help you mitigate such a risk. Then again, injury and disability, you can take a personal accident cover or disability insurance. And then for the fact that, we've seen we live long as per the statistics at global level and even locally, then, we need to have a retirement plan in place, and a pension plan can help you address that. Then when it comes to death before age 16, And, you have dependents, you have people that you're leaving behind. Maybe like for the person we're talking about who had a mortgage that they were still paying, then we have such things like life insurance, we have credit life insurance for loans and debts. And then if it's a mortgage, then we have what we call the mortgage protection covers. So now I want us to really talk about life insurance, because that was to be a special, really specific, a specific emphasis for today's session, and following from the one we had on education, education planning. So a life insurance policy pays a guaranteed amount. You decide how much you want, the cover to be for. And so it pays a guaranteed amount to your nominated beneficiaries on the death of the policyholder. And it can also include other benefits like the critical illness cover as a rider, and can also cover permanent disability cover. So in case you get into an accident or you're permanently disabled, either out of illness or accident, then these are things that you can incorporate into your life insurance cover. And so I think last time we had looked at definitions that would help us understand, some of the things. Who is a policyholder? And this is the person who's buying the cover. A beneficiary, these are the people you're choosing to receive benefits from the policy. And this can be your immediate family, like say your spouse and your children, but maybe you have other people who are dependent like on you, like say your parents are still dependent on you, younger brothers and sisters. So you can choose to incorporate them in the policy, and then you indicate what percentage of the benefits would you want them to receive. And then we say the policy term, this is the period of insurance, how many years that does the cover run for. Then we have what we call the premium payment term. And see here, you can choose to pay. How long do you want to pay for your insurance? Do you want to pay within 10 years, 15 years, 20 years? You want to pay until you retire at age 60 or 65? Or are you comfortable paying for the premium the whole of your life? So those are options that are provided. I think last time we talked about critical illnesses, and these are terminal and major illnesses like cancer, stroke, heart attack, and kidney failure. We talked about disability, and I think also sum assured, and this is the policy value amount. Say you're taking a policy for 20 million, 50 million, 10 million, that is the sum assured, and this is what will be paid to your beneficiaries in the percentages that you choose. So what are the benefits of a life insurance cover? One, it's a tool for wealth transfer to the next generation, because you're choosing your beneficiaries and you're saying, beneficiary A, B, C, D will receive so much. So you can use it as a way of transferring a liquid asset to the next generation. Then again, the beauty of this is it's also not subject to taxation on the payment of benefits. And I'm hoping this is, given the trends happening in our country, I'm hoping this is not an area that will be affected. But as for now, your life insurance benefits are not subjected to tax. So if it's 5 million that you are taking, then to be the 5 million that will be paid out to your beneficiaries with no element of tax. So there's also tax efficiency when it comes to that. Then life insurance is also important. And this, you see, life insurance is not about you, it's about your dependents. So there's lifestyle protection, and then there's that continuity for your dependents, especially for your children if they are still in school, by the time you pass on. Then very key when it comes to estate planning, and that is where insurance now, I'd say, stands out from any other sort of asset. And we know we've looked at the different assets and ways of building wealth. Now, insurance and your life insurance benefits, they are not subjected to the succession planning process. And we've had people dying. We've had people dying, and what happens? It takes at least a minimum of 1 year, if there are no issues, for that whole succession process through the courts, is finalized. And I've seen this for even, very close relatives, that you go to court, you're there with your siblings, and if there are no issues, then it will take, about a year. If there are issues, if there are contentions, if maybe there were other family members that were unknown to your family, and here I'm talking to the men in the, the men on the webinar. Maybe you had another family disclosed or undisclosed, and now they are contesting, and they are fighting for your assets. that could take some time. And as that is being fought, everything is normally frozen. If their bank accounts, these are frozen. If their assets, they cannot be, they cannot be sold or liquidated. And we had like someone, actually a close relative of mine whose father passed on. They had rental properties, but then that had been given to an agent to run. And what happened is, as soon as the agent was aware the father had passed on, they stopped remitting payments, and they said, we'll keep the money until you get the succession documents. And they knew, this is a person they knew. This person had even introduced to them. But in the absence of the primary breadwinner, then you find people really behave differently. But the good thing with insurance, once a claim has been lodged, especially for life insurance, the relevant documents have been submitted, then really on average, within 2 weeks, your beneficiaries have been paid. And so your children can continue being in school. They don't have to be thrown out of your family house, or maybe if you're not living in a family house, maybe you are renting, your family is still able to continue renting. So it's really important. You could have assets, but then those will not be accessible or useful to your family, because of succession once you're gone. And again, now you can use life insurance, to handle posthumous debt. And especially if maybe you're taking a debt, a loan, and there was no, credit life insurance protecting the debt, it means then there'll be creditors coming to try and, get this money. And we've seen people, maybe it was the husband who took a loan, passed on. There was no insurance taken either by the lender of themselves against that loan. So you find, creditors come, they say, your husband owed this much. And so, you're thrown out, and people have lost their homes, they've lost their properties because there was no insurance in place. There was debt by the time the person passed on, but there's no insurance in place to handle that. And so that's why I was saying things like credit life insurance, mortgage protection insurance are really critical to ensure that then at least even if you have debt, that should you then, leave before the debt is paid up, that this kind of insurance can take it up. So I hope we are clear. These are some of the benefits of having a life insurance cover. And I saw one of the things people wanted to know about were the types of life insurance covers. And we look at 4 categories. And the first one is what we call the whole of life cover. And here the policy holder is covered for their entire life. So for all your life, you're covered for all your life. So you take a cover today. If you die tomorrow, some covers, of course, knew they were either sick or planning to commit suicide, and so they take a life insurance. So you find then life insurance covers come and handle that. And then we have what we call the term assurance, and this is normally for a defined period. And what happens, maybe you say and why people take it is because it's cheaper than the whole of life. So you say, maybe I'm taking a cover for, like 10 or 20 years. For some reason, maybe you want it to be used to pay off a debt in case you die within that period. And so you take this cover, and what happens is if you die within the period, then the cover will pay. But if you survive the period, then the cover comes to an end and there'll be no payment made on that. Then we have what we call the endowment covers, and these are combinations of both life insurance and then a savings component. An example is what we looked at last time, like an education policy. So these are endowment covers, and there'll be an element, in case the person dies, there's an element of life cover that would cater and pay their dependents, but there's also money that they've been saving through this policy, and that also becomes payable. Then I think I've talked about credit life insurance. Again, also mortgage protection would fall under credit life. And here, this is used to pay off a borrower's outstanding debt and loan if the policy holder dies. And here I have a really personal example. My mom-in-law passed on, and I think she had taken some property together with some of her children, and so they were joint owners. They were joint policy holders under the policy. And so when she passed on, and after she passed on, then we launched a claim with the insurers. And you see, and I think it wasn't, this was a loan, a mortgage that would have taken around 20 years. And maybe she died 7 years into that policy. And what happened then, you know, that the insurance took up the rest of the loan. And you see, like the property then became like a gift, you know, a gift to the children. Yes, the mother was, you know, had passed on, but then, you know, they are now still, I mean, there was a good outcome in terms of now, you know, the insurance handled that, and now the children then have, you know, loan-free, debt-free property. So those are the four types of insurances, and I'm hoping we are putting in our questions in the chat as we go along. So the key elements, and some of them we've really handled, so I'll really just skip over them. You can choose, so say you're taking a whole of life cover. So this will cover you until, you know, until you pass on, but you can choose, you can either choose to pay the premium from today until you pass on, or you can choose to pay it within 10 years or 15 years or 20 years, or you can choose, you say, I know me, I'm retiring at age 60 and I don't want, you know, to have insurance payment once I'm in retirement. Then you can choose to pay, I'm gonna make payments up to age 60. And we'll be looking at examples of how you can do that. Then the other element is you can take it singly, or like the example that I was saying, like for the credit life for my mom-in-law and her children, my sisters and brothers-in-law, is that they took a joint life option. So you can either take it as a single life or joint life. You know, you can cover a spouse, a person and their spouse, and it pays upon the first death. So once the first death happens, then a payment is made and the cover comes to an end. Then, like we had said, there are options of adding riders like critical illness and disability. Then you get to nominate your beneficiaries and to indicate how much should be paid to each. And I think for people, especially men who have aside families, I think this is also a good way of handling some of those issues, which will really come out later. So maybe sometimes to protect your primary family, or even to sort out, you know, life happens, to sort out the many dependents, then you can use, then anyone you know would bring an issue to your direct family, your primary family, upon your, you know, exit, then you can choose to handle it through your life insurance policy. And what the insurance company will do is pay individually to the people who've been nominated. And normally when you're asked, or we're taking a life policy cover, then you'll be asked who they are, what their details are. No communication will be made to them unless now you have passed on, and that's when communication will happen. And every person will only get to know and to have exactly what had been nominated in the policy. And so when it comes to premium payment, you can opt to pay on a monthly basis, on quarterly basis, semi-annually and annually. And it's normally cheaper if you pay either quarterly, semi-annually and annually. Then you find their premium discounts for long, when you choose to pay, you know, choose to pay a lump sum as opposed to paying your premiums monthly. Then the other benefit, which I'm hoping also does not disappear with the new rules that are happening around tax, is there's a tax relief of up to 15%, a maximum of 6,000 if the policy is 5 years or more. So, sorry, I think this should be 10 years or more. If the policy is 10 years or more, then you get a tax relief of 15%, a maximum of 6,000 every, you know, on a monthly basis. So those are some of the key elements of a life cover. And so your next question could be how much cover? So I've heard about life cover, I've seen its importance. How much cover? How do I know how much cover to take? And so if you're younger, you need to take more cover because you're younger, and because we have seen that when it comes to financial planning, it takes time. It takes time to accumulate wealth, to build wealth. It will take you, you know, it could take you 20 or more years, you know, to build sufficient wealth. So the younger you are, the bigger a cover you need, because one, you have less assets, less wealth accumulated, and it's also, the benefit is that also it's cheaper for you. It's cheaper for you to take cover when you're younger than when you're more aged. Then the rule of thumb when it comes to life insurance, it is take 10 times. What is adequate is at least 10 times your annual income. And then you can, when you work that out, then you can discount this based on what your budget is and also what you can afford. But then the rule of thumb is at least whatever either your salary is or 10 times your salary or annual income, then and we'll be looking at an example of how we can calculate that. Now, if you have debt that is not backed up by a credit life insurance, please factor in this. So supposing now you have a mortgage that is not backed up with a mortgage protection cover, or maybe you have a personal loan that but at least I know personal loans with banks, those ones are well protected. But supposing like I know, like these houses that are being sold by National Housing Corporation, they actually don't have mortgage protection covers. So if you maybe you purchased a house through them and you're doing it through a tenancy purchase scheme, then you need to factor in this so that in the event of your passing on, your family does not lose that property. So if there's a debt element, then apart from, the rule of thumb, then ensure there's enough to cover your debt and also to leave enough maybe that they had when you were alive. Then we've talked about critical illness. For this, you need to at least buy 5 times your annual income. And this is to cater for those kind of things we're saying, like instances of cancer that is really expensive. Also, issues to do with kidney failure, dialysis is also quite expensive. So a good cover, and you see like your medical insurance has a limit, even NHIF has limits. So it's good to have a critical illness cover that can then, be used to top up that without you having to sell an asset or liquidate your investments. So when it comes to premium calculation, what are the factors looked at? And some of them is age. And we're saying the younger you are, the cheaper it is, because you're less risky as far as the insurance company is concerned. Then premium payment term, do you want to pay it within 10 years, 15 years, 20 years? And when you're sitting with your insurance agent, ask them to give you calculations across all. And we'll be looking at that in the example, and then see the one that makes more sense to you, the one that is more favorable. Then do you want to add additional benefits like critical illness, disability? Then this also come at a cost. Then what sum assured? Are you looking at 10 million? Are you looking at 20 million, 30 million, 50 million? The sum assured would also determine the cost of the cover. Then again, your health status. Now, you find we have what we call the free cover limit. And say, like, for example, I know a company that has a free cover limit of 5 million. If you're taking a sum assured that is more than 5 million, then they require you to go for medical examination. Then based on what comes out of those medical tests, your premium can remain the same at standard rates. If you maybe have a critical illness, chronic ailments, then you can find then you'll be charged a higher premium or be asked to take lower benefits. If you're not willing to pay more premium, maybe you say, my budget for this is, like say 15,000. So what will happen is that then they'll offer you a lower sum assured as opposed to increasing your premium. So that's something to also take note of. Are you a smoker or non-smokers? Smokers have a short lifespan, as the research has shown. So if you're a smoker, you definitely be incurring higher premiums than a non-smoker. So there are some of these habits we pick in, especially in youth, adulthood. So when it comes to insurance, I'd say buy early, buy enough. Then target a payment term that's within your active years. If you plan to work until age 60, make sure you're done with your premium payments by age 60 or even earlier. If your plan is maybe you plan to, retire early, then ensure that you pay your premiums within that, and then you'll continue to enjoy cover for life, but you no longer have the burden of, paying for the premiums. Someone had said, when we're talking about piggy banks, someone had said, workplace is taking care of this, workplace is taking care of this. But sometimes that is an illusion. You can have a very good employer with extremely good benefits. But the day you step out of that employment, all those benefits come to an end. If you had a very good medical, It could even have been an international cover. The day you leave, it ends. If you had a very good, group life insurance cover, it was covering you for, limits, 25 million, 30 million, 50 million. That day you leave in employment, it comes to an end. And this can be very painful because sometimes you're leaving employment at an advanced age. And I've seen people who, you tell them to buy insurance when they were working, they're like, Apana, me, my workplace is really giving me very good medical benefits, giving me very good, life cover, very good personal accident cover. I don't need insurance. And then you step out at 60, and some maybe you even got a contract extended to 85. And then then you realize when you leave, you don't have medical, you don't have life insurance, and now you're trying to purchase. And I can tell you, and we'll be looking at examples, it's very expensive to buy at those ages. And sometimes even no insurance will accept you. You have the money, but you're not eligible because you're over the age limit that they take. So for those who are in employment, please, the day you leave employment, those insurance benefits come to an end. So don't have your own, and especially when it comes to life insurance, and maybe also education planning, please have something that is outside your employer. Have a plan that is outside of that. So we'll be looking at a case study, and here, this can be either, okay, I'm biased, I'm female. So female clients, the ones we are seeing are living longer. So they are age 35 currently, they are a non-smoker. Their annual income is 3 million, that is annually. So we had said when it comes to life insurance, aim for 10 times your annual income. So we are saying take a sum assured of 30 million. Then CI is critical illness. We said at least get 5 times your annual income. So that comes to 15 million. Then again, when it comes to permanent and total disability, then take at least 15 million, because then that can take you for a while. No same as a critical illness cover. So then we are choosing a payment term of 20 years, because you're saying by the time I'm 55, I want to be done with paying my insurance premium. So let's look at a couple of calculations. So for this person, if they decide now, so they're currently 35, but what's, so the cover, the premium for them for a 30 million cover with critical illness of 15 million, a disability cover of 15 million, the premiums per month is 23. But had they chosen now to take this cover when they are 30, they've been paying a lower amount of 19,000, almost 20,000. If they decide to wait until they are 40, they'll be paying 29,800 per month. And you can see how it increases all the way to 860. But for that same amount of benefits, same period of time, by the time you're 60, you'll be paying, how many times? Many more times what you'd have paid at age 35 or even age 30 if you chose to start early. And that's why I'm saying buy early, it is cheaper. Then if you're a smoker, you can see if you're age 30, a smoker, then the non-smoker will be paying 19,000. As a smoker, you're paying 24. So some habits don't help us, they cost us eventually. And here we're saying, so if you're paying for 20 years, if you started off at age 30, then you pay a total of 4.7 over that 20 years. If you start at 35, you can see you'll be paying more, 5.6 for the same 20 years. If you wait until you're 40 to start and pay for 20 years, you have paid more over a 20-year period, and it increases. So by the time you're 16 and you're paying until you're 80, you'll have paid out insurance premiums worth 35 million. And so there it doesn't make sense, because you're paying a total of 35 million for a cover of 30 million. So don't wait until the illustration here is showing one, start early, it's cheaper when you'll actually spend less if you take your cover earlier. And so now the next scenario is the one of payment terms. How do you know? Do I choose a 10-year term? Do I choose 20 years, 15 years? How do I get to know what to do? So for 10 years, for this same person, for 10 years, you pay 33, assuming here, this person is the 35-year-old. You'll pay, if you want to compress now the premiums, because the scenario here, we're looking at 20 years. If you want to compress the premiums within 10 years, then you'll be paying a bit more. Instead of 23, you'll be paying 33. But overall, you have paid in those 10 years, you'll have paid 4.0 million. If you stretch it over 15 years, you'll be paying 26 million, 26,000, sorry, per month. And then you have paid a total of 4.7 over that period. And if you have paid, again, we already looked at this example, at 20 years, you'll be paying 23, a total of 5.6. And so if you pay up to 860, you'll be paying, yes, a smaller amount, but overall you'll have paid more if you choose to pay until 860. So that's what I'm saying, when you're meeting with your with your insurance agent, ask for all these computations so that then you're able to choose a payment term that works best for you. Because you can see now here, the most favorable is actually to pay a bit more now, but overall maybe pay 4 million instead of 4.7 or 5.6 or 6.7 or 7.7 or 12.7. So that is the calculation. And I hope it's now clear and we can take questions at the end. Now, time is not on our side and retirement planning is a whole issue. So I'll just give very brief highlights. When it comes to retirement planning, you need to be putting aside at least 20% of your salary towards your retirement. Then for people who are in employment, you move from employer, between this year to this year, you're this employer, then you got greener pastures, you move to another employer, there was a pension scheme there. And what I find people doing is we tend to leave, especially our employer's portion of our pension, with that scheme where it was. And this can be quite costly. Like now we had a family friend of ours who passed on. And right now I'm trying to help the wife, trace all the husbands, trace his pension contributions from about 4 employers. Some of them, the people who are there, no longer there. Some of the trustees are quite uncooperative. So it is really quite a headache. So I advise, if you have pension with your current employer, when you move to another one, please ensure that you open an individual pension plan, transfer your money there, and every time you move, then just put it in there. So at least you're keeping track of your, pension contributions in one place, rather than it being all scattered over the place, and it becomes a real headache, even for you. Trying to consolidate that, at the point of retirement, or even maybe if you pass on, then it becomes a real headache for your dependents. And then if you can do it, if you can avoid it, please avoid withdrawing your pension benefits as you change employers. It's something, it's something we normally do a lot, especially you've been employed, you're looking at that as, money that you can do a project with. But then what happens is that you're eating into your retirement savings and it catches up with you in retirement. You find maybe you've not saved enough for retirement, and maybe what you're getting out as a pension is very little. And then it's important, and this is something that I painfully experienced, because especially when we have pension schemes that are through our employer, we are not too keen on what the interest rates are. Because you see, you're not the one handling that. And this for me, I was in one of my employers. I was there for 9 years. And then I moved to another employer where I worked for 4 years. In those 4 years, I left my pension at that particular company. And what happened, that particular company was not doing well over those 4 years. And when I later now came to realize, I had lost about $500,000 in foregone interest just by keeping my money, at that company and not moving it to another, because I wasn't bothered. And this is something, especially for those who are in employment, it's something we're not keen about. And I just want to share, I'll be sharing something. Let's just finish with this. So life insurance 10 times, education cover 5 times your income, retirement 20%, medical 5 times, emergency funds 6 to 12 months of your expenses. Now, I just want to share something from the market, because I know most of us are not keen. And these are statistics. And I want you, if you're employed or have been employed, to quickly go through this list. Where have your pensions been? Or where have your pensions, are your pensions currently? Can you see the performance across? And can you see the average over the period? And it's important, especially when you leave an employer. Okay, if you're an employer, the best you can do is to question. There are always those pension meetings, and you find sometimes people don't contribute because you're really not, especially the younger people don't contribute because it doesn't make sense. But sometimes we also need to question our trustees, question our HR. Why are you choosing to keep us, in someone who's offering an average of 4.8, for example, where, we could be in a company that is giving us 11.21. Because this affects you, this will affect you when you retire at the end of the day. So if you want to know more about this in terms of how can you consolidate, how can help with this, then, but I thought this was really important because it's something that really personally costed me. And out of that, I developed a passion just to help, especially people who are moving jobs, just consolidate and make sure that your money is growing so that you'll have enough in retirement. And I believe I am now at the end. And yes, I'll leave that there in case you need to reach out. You can reach out either using the phone number, the email address is also there. And if you don't want to book an appointment, this I'll also share through the officials, and you can get in touch with me for assistance, either in setting up a life insurance, maybe tackling pension issues or any other aspect, even education planning, then I'm really happy to assist. And I think with that, I will stop sharing, and probably, Eva, we can look at any questions. Someone was saying, redisplay the slide on the rule of thumb. Let me do that. Give me 1 minute. Let me just get to the slide itself and then share. Right. So those are the rules of thumb. In terms of when you're thinking, sorry, how much? Then for life insurance, 10 times annual income. Education, at least, especially when you're starting early, 5%. If you're starting to plan for your education later, then maybe you need to put, at least 20%.
Something has happened to your audio.
Oh, sorry, you can't hear me.
We can hear you now.
All right, I think I'd moved away. So those are the rules of thumb for the person who had asked. So at least that can give a guide in terms of what you need to have in terms of all those baskets. So Eve, I think I can now bring it back to you, and we can answer any questions and maybe get any reactions, and I'll be happy to tackle any. And I know time really flies, and that's why we can't even really handle retirement planning in entirety.
So as others, as I look through, mine is a request. Can you go back to your slide on the different returns of the different retirement provide the pension?
Okay, let me just do that. Okay, so there we are. Right, so there we are. Mm-hmm.
Mm-hmm. So
Reactions?
mine is actually a couple of questions on this particular slide.
Mhm.
Is there anywhere where this data is published? Because unlike so many other, like the way you find money market funds, things,
Mm.
the
Mhm.
returns on pension providers
Yes.
to be hidden. So is there like a report or a place where I can find this data? Is my first question.
Uh-huh.
Second question I have, the rates that are written here,
Mhm.
are actually what is given to the pension providers, or is this like a gross return?
So for some, they'll give you what you see here. So this is what is declared.
Mhm.
So for some, you find, especially where you're in a corporate, some will net off some charges, especially where you're going through like a fund administrator. You find the net off a certain, so you find your net return is actually lower than what has been declared. So it's also important to question that, especially when you go for the pension meeting. They'll tell you, they can give you a very glossy, 11%, but then, then they net it off and maybe what you're getting is 9%. So it's really important to question that, especially when you go for those, the AGMs, the pension AGMs that are now mandatory. Now, when it comes to your first question, where can you find this? Now, this you need to comb through like all the, the respective, you look for the APA once they publish, and they'll be publishing actually from end of 31st March. The companies now will start publishing what their performance was for 2022, and this will be part of the reporting. And you see now the benefit of having now an insurance agency is I'll be able to get all this and collect it for you. Otherwise, then you'll have to sit for yourself and look for it. Look for it individually.
Okay, so if I look for Mercy will be able not only to tell me the gross, but she'll tell me the net so that I'm actually getting
Yes.
the.
Yeah.
Oh, okay. Then my last question on this is some of these are blank. Like I see Prudential seems to be doing quite well, but data starts in 2020. So does that not in the, they were not registered pension providers, or what does that mean before 2020?
Yes. Actually, before 2020, for the case of Prudential, they were not doing pension prior to that. So there's no data for them for that period. Then you find like people like corporate, there are also people who got out of it. Like you find around, I think it was 2018, 2019, where there came the new rules that insurance companies, they used to be composite. So a combination of a life and general insurance company. So a lot of companies used to hide there. Some are doing badly, but because the books are consolidated, you'll not be able to tell how badly they are doing. So there came a regulation from the Insurance Regulatory Authority that then you must split the general insurance and the life insurance. So you find a couple of people who didn't want then to get into one class, or maybe were not doing like the likes of corporate, they actually stopped doing then, pension business. So people who had schemes with them, then those schemes had to be transferred out. And that's why you find now from 2019 to 2021, then there's no data for them. Same to Kenya Orient. And then there are other companies that were taken over by other companies. Like who is this? So you find like those who bought others. Like now you'd find there used to be Heritage, but then that now they also stopped that business, and maybe that was taken over by someone else. So that's why you find now the gaps for some of them. Either it's when you started, that you started say in 2020 for Prudential, or for some, it's when they stopped. Or maybe it's for some in a particular year, they did not declare anything because maybe the performance was really poor. So there's nothing published, there's nothing declared. And when something is not declared, there's what is called the nominal, the guaranteed interest rate. And you find for most is between 4 and 5%. So instead, so that was what was credited to the pension holders. But you see, because that is very prejudicial, if you put that out in the market, so for those, they chose to keep quiet in those years, especially when they were not doing well. So I hope we are clear on that, Eve, and any other person who had a question around this.
Yes, that is quite clear to me. The other thing is maybe some general queries first before I tackle specifically what is in the Q&A.
Mm-hmm.
And general, in fact, some of them come with their own introductory, you know, how we introduced you.
Mm-hmm.
So the thing is, you know, your profile says that you're a certified insurance agent. And while this sounds an obvious question, as a client, because out there we have all manner of people, how does a client actually verify that they're dealing with a certified insurance agent?
Okay, right now, there's regulation around that. So there's regulation around that for you to practice as an insurance agent, then there are minimum standards, and this is what we call the certificate of proficiency. So someone to practice as an agent, then you at least must have that. But then you find very many people. So beyond that, what you need to ask is how much experience in that industry. Because you see, today someone could come from school and they decide to pursue an a career as an insurance agent. They will go sit for 2 weeks at the College of Insurance, ECOP, the ECOP insurance, and after 2 weeks they will pass. And they'll pass and they'll get their license to practice. But do they know the nitty-gritty? So apart from the license, apart from the licensing, then the years of experience are really critical. You really need to question that. You really need to question that. And maybe also do like a background check on the person if possible. So, okay, you're telling me where did you work? What were you doing? What kind of insurance were you handling? So that then you don't become very gullible, because there are some people who also get into insurance, for the sake of, getting money. And really that is their motivation. They may not really be very well versed even with the products and, what it is, the kind of advice they're giving you. So it's important then you do your due diligence around that. But one, minimum certificate of proficiency, but also how much experience and in what. For what you're telling me, how much experience do you have in this area? And you'll be able to use that even by questions, you can see maybe the level of responses, but salespeople are also quite confident. So, they can give you an answer hard-eyed and come out very confidently. So you need to do a bit of due diligence around that. Yeah, so I hope we're clear on that, Evelyn.
Yes, quite clear. For me, the other thing will be around, we've had scenarios where we've had some insurance companies either going into receivership, basically going. So instances, what happens to the products to what happens to the insured?
Okay, no, that's a good question. Now, part of the premium that you will pay, a part of it is an element you see called PCF, and this stands for the Policyholders Compensation Fund. So every premium for every policy that's taken is a certain amount that is equivalent to 0.45% of the premium that then is collected, but then it is sent to this Policyholders Fund. And what happens is if a company is unable to meet their obligation, then when, say a maturity falls due, then this is normally paid now from this Policyholders Compensation Fund. So there's that backing. So it's not like all lost, and especially for life insurance, especially for life insurance. But now it's across for all products, both general insurance and even life insurance products. So you can make a claim to this, the Policyholders Compensation Fund, and you'll be able to get your money.
So for this compensation fund, how much recovery is somebody looking at? Is it complete recovery or only a fraction?
For life insurance, it's almost complete recovery. For general insurance, it may not be. They have a limit. Allow me to come back to you. I can share that information. I'll need to get you the specifics for that, but I know it's higher for life insurance. Again, because general insurance contracts are 1-year contracts. So, you know, you have the option of moving to another insurer. So you find there maybe the awards, they are much lower, but because life tends to be for a longer period, you know, you're talking about 5 years, 10 years, 20 years, maybe someone has paid for the whole of their life, then you find the awards under life insurance are higher. But I'll share the specifics with you, then you can share with a group, you know, outside of this.
Okay, then the other thing is, in case there's a dispute between me as the insured and an insurance, you know, provider, and it's a failure of my understanding the terms and conditions of my policy. So, for example, you know, I've heard of scenarios in the past where somebody, let's say, has a medical cover, for example, then they an illness that is consuming quite a bit of money, and there's attempts to dodge payment.
You
know, those
sadly.
kind of scenarios. So, you know, what is the way out, or what is the basically the insured take for disputes in a way that doesn't leave them without, you know, I took as risk. Now I'm in the risky situation. How are you living on my own?
So for this one, okay, first, you know, you first exhaust whatever avenues there are internally, you know, all the way to the MD if you can't. But if you're not getting any help, then we have now the Insurance Regulatory Authority, and this is the one that licenses insurance companies in Kenya. So they have what they call the Consumer Protection Unit. And here their role are actually to receive such disputes, review them, and a part of my work in one of my companies, and what they do is that they'll, once a dispute is made by, say, you, who's the aggrieved person, so you put it in writing, you take it to them, then what they do is they will put that complaint to the insurance company. And the insurance company is actually either the person, the claims manager, or the principal officer is required to make a response, then based and provide documentary proof. So they can say this claim was reported to us on this day, this is what we have done, this is what we have done. We came to this decision because of X, Y, Z. Now, if that is sufficient, then, you know, based on the evidence provided, IRA, for Insurance Regulatory Authority, they can make a ruling, you know, for or against. But sometimes they'll also be called, you'll be called, actually, all of you, the complainant and the insurance company, you know, come represent your issue here. What are the merits or demerits of this? And insurance do get, that a regulator has the right, the authority to actually compel a company where you're found to have acted unfairly to a customer. They can actually compel you to make a, you know, a payment, and they now have a right. Before a matter goes to court, they can make a final judgment on that matter, and it is binding on the insurance company. So like I was saying, actually part of my work, I attended a couple of meetings, you know, where a claim went this way. So you're summoned by the regulator, you go, you know, give your findings, and you find then, you know, it's looked at fairly, you know, with fairness, again, to both parties, because sometimes you find clients are either misguided, say by an agent or a broker, or information to the client. And
your
so
audio, something is happening to your audio again.
Oh, sorry. So you find then the unit will be able to make a decision around that. And normally they are quite favorable to consumers.
Okay, so maybe I can see people are dropping off. We can quickly tackle some of the queries that are on the chat. Asking, I think you mentioned that insurance policies are subject to nomination rather than succession. So there's a relation to that. What fall out with a previously elected beneficiary, like a spouse? Do you amend them?
Now, yes, when it comes to now policy management, and I've seen that it's important, you know, sometimes maybe when you took a policy, maybe you took it when you were younger, before you got married. So maybe the nominated beneficiaries were, say, your parents, but now you're married with children, you need to include any other beneficiaries. Now, if, say, you've fallen out with your spouse, sometimes then you also need to then make amendments, and they're normally beneficiary nomination forms that you sign initially and that you can also use to amend. to actually amend any, to amend any decisions around beneficiary nomination.
Okay, then we have, I think, related questions around medical and critical illness cover. So perhaps read through all of them. So which illnesses are covered in the critical illness cover? Is it a harmonized or will it vary from one insurance provider to another? The second query is if you're getting medical cover from your workplace, how do you go about an additional cover that will go on even after retirement? What do you need to look for? And then on the chart is actually my own question. There is this, what you've seen about, some companies providing post-retirement medical covers.
Yes.
So actually, does that mean, am I paying now for that duration? Paying a duration, I mean a lump sum at retirement? What actually does a retirement medical cover mean?
Okay.
Yeah.
All right. So are there any others under this particular, maybe medical?
I don't see another unless I've missed, but I can see there's somebody who has raised their hand. Kevin Muthama.
Yes.
You can unmute yourself if you have a question you'd like to ask.
Good evening.
Good evening.
Good evening.
Thank you for the presentation. My question is in regard to the chart that you have shared for the declared returns.
Yes.
Do we have a place where we can find the market share of these participants, of the insurance companies? The reason I'm asking, when I signed up for my retirement cover about almost 10 years ago, I had looked at those stats. I saw a company that was offering a double-digit return. I signed up with them. Then a few years down the line, I decided to ask for my statement, only to find that I think there were 2 years that the company had run into losses.
Yes.
And in that case, they had not declared a return. So I made a decision. I moved my cover from that company, and I actually split my contributions from that time henceforth. But I've also seen from this chart that one of the companies that I remit my monthly contributions to has also not been doing well. So is there a place where we can get the data on the market share so that if you make a decision to move, you don't move because of a high return of a company that maybe is trying to penetrate the market?
Okay.
Thank you.
All right. I think let me start with that, and then I'll address the medical questions together. Now, and I think I've responded to Evelyn on this. Now, right now, okay, in terms of market share, you can get market share from the IRA website. Actually, after 31st of March, you'll be able to find published. The market, okay, their report will come out a bit later, but then you'll be able to see, the industry report. Like now, if you go to the IRA website, you can get the IRA report for the insurance industry, at least as at 2021, as at the end of 2021, because the one they're going to put up now is after people have done their submissions for 2022. So that's a place where you can go and you'll be able to compare market share and all that. But then now when it comes to declared interest rates, that will not find in that report. So that requires a bit more digging. And that is where I was saying, one, at least your insurance agents can help you with that digging because they'll be able to, get that information. because mostly you find like now, say an agent is dealing with a number of companies, so they are readily able to get that information. Otherwise, then you need to sit and becoming either the internet and becoming the websites, becoming the gazette, especially for those listed companies who normally have to put their published accounts in the papers. Then for those, then that is the only place where you can get that information. So, and my other advice is keep track. Just because you signed up when they were doing well, and you see that is how I lost $500,000 in interest, is because at the point at which I was in that company was doing extremely well. But in those years I was away, then they did really poorly. And that really impacted, the return that they were able to give, pension holders. And that's quite a bit of money, now especially when you're very broke and you remember those kind of monies, then you get really upset. But then it tells you then you should, really be diligent on a yearly basis. If you have an agent, demand for that information. If you're with a company, actually, most of them now have portals where you can be looking at your statements. Otherwise, then at least demand your statements if they can't give you monthly, let them give you quarterly. That at the end of every quarter, you want to be seeing, how your pension money is, how your pension money is growing. But for many of us, especially who are employed, we are very lax around that. So you come to realize much, much later when you've lost quite a bit in this, you can't remedy the past. So be diligent, ask for your statements, but also after 31st of March of every year, at least by mid-April, then do demand that you're given an annual statement that shows now what was the declared interest and how that has been applied now to your particular benefits. Then through your agents, then get the market information. So I hope that is clear, Kevin.
Yes. Thank you.
All right, Asante. So let me quickly handle critical illnesses. Like I said, during education planning, the previous one, they are normally listed in the policy. So find out which ones, because something could be a critical illness, which the insurance company is not, and they differ. There are standard ones like cancer for all of them, kidney failure, paralysis, kidney failure, organ transplant, those kind of things. Those are standard across, but then you find one or two differentiations. Either an insurer would have more than one, maybe one more extra than others, or some maybe will have less. So you need to know which critical illnesses are covered. Then you really need to look at your policy to be sure. Then when it comes to a medical cover, so you had a medical cover with your insurance company, with your employer. So for this, I advise, you may not need to take another medical cover per se, but what you can buy is a cover has a limit on how much is payable for critical illnesses, chronic ailments, pre-existing conditions. So you'd find, like, say, for a cover of 1 million, you have a cover of 1 million inpatient, only 300,000 is going towards chronic critical conditions, and this money is paid to the service provider. But then you see, like a critical illness, you can take all the way, even to 10 million, 15 million, 20 million. You're able to get that kind of benefit. So I'd advise, if you're still in employment and you have a good cover, you don't need to substitute it. Then all you need to do in addition is get for illness cover. So that is how you back that up. Then I think there's a question on post-retirement covers, and these are covers now for senior citizens that you get to purchase, you get to purchase upon retirement. And so what used to happen is before there were these post-retirement covers, what would happen when you retire at age 60, you no longer were on insurance. There was no insurance company offering medical covers for someone who's age 60 and above. So you find that most retirees will be left with their own, medical bills. So what has happened now, the market, at least quite a number of companies are offering these post-retirement medical covers, and you can purchase them. They are a bit higher because, you know, you're also older at that age. But I say when you're taking this, you need a lot of guidance. One, on which one to take, again, depending, because there are a number of factors. There are a number of factors based on your health. What is your health? How old are you by the time you're coming to take this cover? Because some, they'll only take you up to, they'll take you in at age, maximum age of 74. And for some, you can be covered for life. There are those who take you maybe at a maximum of age 79, and again for life. And there you find some that will drop you at age 80, some will drop you off at age 85. So it's important when it comes to that, when you're coming to purchase this, not all retirement covers are the same. And you can fund this either from your pension benefits, and you can start saving now, but there is an allowance under the law, and that's a whole different topic now when it comes to retirement planning. You can actually start saving now towards a fund for your retirement. You can use that purchase cover now once you retire. But that, like I'm saying, that whole bit of pension and retirement planning is a whole wider topic, and will not be able to adequately handle it. So back to you, Eva.
So I think this brings us to the end of our questions, and I think we're also at 9 p.m.
Yes.
Yes.
Yeah.
I think I speak on behalf of the entire group when I say thank you so much. You've taken us through 2 sessions, and I think we are wiser. And I hope some of the people in the audience can see the wisdom of going with a seasoned agent. I think you came to my attention because of regular marketing of post-retirement of medical covers for seniors at a time when I was going through my own crisis with a parent. And I know you're very passionate also about medical covers for seniors. Yes, so thank you so very much. I think personally I've learned a lot. If nothing else, I hope everybody in this session has learned that insurance is not investment, it is protection, and protection definitely has a big component, is a big component of also financial planning.
Yes, yeah.
I hope that message is home and dry. I also want to thank you for today's case studies. I know unlike the other time, today we did not give you specific, case scenarios, but I think the many examples that you give really have driven home the point. So asante sana. I think, those would be my parting remarks.
All right, and thank you
also put your contact.
Yes,
I have put your contact in the chat box for anyone who may wish to reach out to you, and the recording session will also be shared with the members of the Investable team.
All right. Yeah, but I really appreciate the opportunity and even the engagement today. Yes, but all this boils down to action. Sometimes we hear so much, but it is what helps us is what we actually practice. So my joy would be to hear that, out of the things you've learned, through the whole process, and even this, that there's something that has, that you put in place that will not only help you, but also help, your dependents and your generation. So asante sana for the invite, and let me wish you a good night.
Good night to all. Asante.